Welcome, everyone, and thank you for taking the time to attend this important student debt clinic. I'm excited to share this information with you as a proud member of the American Federation of Teachers. We are offering this information not only to colleagues, but to public service um, workers, as well as anyone who has attended college and obtained a student loan. We know that you may be here for a few reasons, and you may be new to student loan repayment. Maybe you heard about different loan cancellation or forgiveness programs and wanted to see if you were eligible. Or maybe you are hoping to get some clarity on what's going on with a very confusing return to repayment. Across the country, people just like you have these same concerns. And my hope is that you find today's session useful for whatever reason you're here. I know that you'll have questions, and we'll have time after the presentation to answer them. But if you have questions once we conclude, please take note of the email on the slide and don't hesitate to contact us. The email is debtclinic@aft.org. We're here to discuss programs that could help you relieve your debt. And the programs that we will be discussing today have not been affected by the recent decision by the Supreme Court reversing the broad-based debt cancellation. And they work together to lower your payments and put you on the road to forgiveness. First, we'll cover income-driven repayment, or IDR. That's how we refer to it. IDR plans, which are available in some form to all federal student loan borrowers and may help you lower your monthly payments. If you plan to pursue public service loan forgiveness, or PSLF for short, you'll need to be in an income-driven repayment plan for your payments to qualify. Then we'll go over the PSLF, Public Service Loan Forgiveness, which is for people who work for any level of government or for a nonprofit. And it can lead to you having the balance of your student loan debt forgiven after 120 one-time payments if you qualify. Finally, we're going to talk throughout the program about Summer. Summer is a free member benefit for AFT members that provides extra support for enrolling in these programs and will help you stay on top of any additional changes in the programs that may come about. While getting people individual relief is obviously important, we also need to think about a collective response to not only ensure that these programs remain available, but that we also prevent future generations from finding themselves in a similar situation. The programs we're discussing tonight exist because of concerted action by student loan borrowers like you, and there's still a lot of work to be done to ensure that no one finds themselves unable to escape the burden of student debt, including work for broad-based debt cancellation and affordable higher education. It's the reason we're offering these debt clinics, to provide important resources and information to our members, as well as to build a stronger union so we can solve more problems like these inside and outside our workplaces. Here's a little bit of context for us. There are currently over 45 million people with student debt. Before March 2020, 1 out of every 5 borrowers were in default because they hadn't been able to make a payment on their students' debt for more than a year. That's 9 million people. In the short time since payments have resumed, we are already seeing borrowers who are struggling with the complicated system and poor loan servicing. Although millions of individuals are struggling under the common burden of student debt, this burden, like so many others, is an intersectional one. Student debt is bad for everyone, but on average, it's even worse if you are Black, brown, older, or a woman. Students of color are more likely to borrow for their education due to the racial wealth gap. Black college graduates owe on average $25,000 more on their student loans than their white counterparts. One study found that 12 years after leaving school, the median white borrower has paid down 35% of their student debt, while the median Black borrower owes 113% of their original balance. Women hold over 60% of the outstanding student loan balance in the United States. On average, Black women borrowed $6,000 more for their college education than white women, and $8,000 more than white men. While we may think of student debt as a problem affecting primarily young people, it's a cross-generational issue. Americans over 50 years old hold about 20% of all outstanding federal student loan debt, and they're struggling to repay it. For older Americans, falling behind on their student debt can have catastrophic consequences, including losing out on a portion of their Social Security checks. Once we put all that together, it's clear that student debt isn't an individual issue. Via collective action, we've made changes that will help millions of people in the communities that have struggled the most. But there is more work to be done to ensure that no one is left behind. Now, as a quick note before we dive in, we are not considered financial advisors. We're going to be providing an overview about these programs, not giving personal, financial, or tax advice. The information about how these programs work will help you make informed decisions about managing your student loan debt. But you should make those decisions with your family and maybe a financial advisor. We also want to underline an important reality. To meaningfully access any of the programs I'll describe here, you have to pay attention to every piece of correspondence you get from your servicer, and they need to be able to reach you. The student loan servicing system is frustrating, and avoiding correspondence from your servicers is a normal response to that frustration that you shouldn't indulge. Given how often rules change and accounts are transferred, you need to make sure you are receiving and reading all notifications from the Department of Education and your student loan servicer so that you know how these changes will affect you. It's important to make sure your email and postal addresses are up to date in your federal student aid or FSA account and with your loan servicer. You can update your information at the United States Department of Education's federal student aid site at studentaid.gov. Keep an eye on emails and regular correspondence from federal student aid, from your current servicer, and from other loan servicers. American Federation of Teacher members also have access to a free member benefit called Summer that can help you better manage the paperwork, make sense of your available options, and keep you on track for loan forgiveness. Additionally, Summer can help AFT members gain access to other options if income-driven repayment and public service loan forgiveness aren't the right fit, including ones that may help with private loans and These may include additional state and occupation-specific options that we will not cover here. The summer website is on the front page of your resource guide, and we'll talk about the resource guide that I'm going to be able to provide to you all with links and websites and things of that sort if you hang around. Okay. So let me go to the next slide. Income-driven repayment plans. Hold on a second. Okay. The path to public service loan forgiveness. So whether you've been paying on your loans for years or you just finished school, we're going to start this presentation at the beginning of your student loan repayment cycle. When you leave school, there is a 6-month grace period during which you're not required to make any payments on your student loans. Once the grace period ends, you are automatically placed in a 10-year standard repayment plan. This repayment plan is something like a fixed mortgage. The way they figure out how much you pay is simply how much would you have to pay every month to pay off your debt in 10 years. That's the default plan. But the default is not the right fit for many people, especially if you're pursuing public service loan forgiveness. In addition to the 10-year standard repayment plan, there are many other types of repayment plans. The people who are supposed to help you navigate this system are called student loan servicers. Many of you have heard of Ed Financial, AidVantage, Nelnet, Mohela, or Great Lakes, among others. The people that send you a bill every month, that's your servicer. It's not uncommon for accounts to be transferred between servicers or for servicers to leave the student loan servicing business. This often causes additional confusion for borrowers as accounts are being transferred. It's important to make sure your contact information is regularly updated and that you pay attention to correspondence from your servicers for these notices. Loan servicers have been known to give confusing information about repayment plans, and sometimes they've steered borrowers into plans, deferments, or forbearances that left the borrower worse off. We're going to put most of these other options to the side and focus on the 4 income-driven repayment plans that are best for most people and are part of the requirements for public service loan forgiveness. Income-driven repayment and public service loan forgiveness are free to enroll in. However, there are thousands of scam companies that will charge hundreds of dollars to do this for you, and you should never pay them. If you're contacted by one of these scam companies, file a complaint with the Consumer Financial Protection Bureau immediately. You'll find their website on the front page of your research, the resource guide that I'm going to give you, but it's also here where it says reports scams. Income-driven repayment plans are a repayment plan that bases your monthly payment on your adjusted gross income and family size rather than how much you owe. Your payments through these plans can be as low as $0 per month, and these plans can even cancel your remaining student debt in as soon as 10 and or no more or and after no more than 25 years. So again, they can cancel your remaining student debt in as soon as 10 and after no more than 25 years, regardless of where you work. These repayment plans and forgiveness programs are for federal student loans, which make up about 90% of all student loans today. There are a few different types of federal student loans. Which type you have will vary depending primarily on when you took out your loan and on whether you took it out for yourself or your dependent. What matters is that it's a federal student loan. So in general, there are 4 buckets of these loans. There's direct federal, there's the federal family education loans, or we call it FEL, FFEL loans. You have Perkins loans, and you have Parent Plus loans. If you have one of these types of loans, you qualify for at least one of these repayment plans we're discussing today and have access to Public Service Loan Forgiveness, PSLF. Unfortunately, private student loans are not covered by any of what we'll discuss today. If you're not sure whether your loans are private or federal, check the loan name on your monthly bill, log into your FSA account, or call your servicer and ask whether your loan is a federal loan and what kind of loan it is. If you are a member of the summer program, the summer student loan tool can be used to determine which loans are federal and which are private. However, like I said previously, summer is only offered to American Federation of Teacher members, union members. So, but you can call your servicer or FSA and they can help you. Before we jump into more details about income-driven repayment plans, there are a few things we're going to define that will affect how much you'll pay. Discretionary income. That is the difference between your adjusted gross income and 150% or 225% of the federal poverty guideline for your family size. So depending on the plan you select, that's how that will work. So let's say it another way. Anything you bring in that's over 150% or 225% of the poverty guideline is your discretionary income. Your discretionary income is calculated based on what you are reporting to IRS as your adjusted gross income. That means any income going towards pre-tax items like health insurance premiums shouldn't appear in the income used to determine what you pay every month. So we're not going to count that income if you're paying into health insurance and things of that sort. So family size, when it comes to these repayment plans, your family size may be different from the number of exemptions you claim on your federal income tax return or the number of dependents you have as defined by the IRS. So it may be different. Family size includes you, your spouse, if you file your taxes jointly, and your children. If you are covering more than 50% of their living expenses, your children will be covered. So in most cases you do, but it does not matter where they live, as long as you're covering 50% or more of their living expenses. It also includes unborn children who will be born during the year for which you are certifying your income. We'll go into this certification in a minute. For all of the income-driven repayment plans we are discussing here, family size also includes other people. For example, older family members, if they live with you now, they receive more than half their support from you now, and will continue to receive this support for the year that you certify your family size. Remember those terms, okay? Discretionary income and family size. And let's talk further about income-driven repayment plans. If you want to follow along in with the resource guide, once you get it and you go back and rewatch this, if you want to, get a better understanding, all of this, these are listed on page 2 of that resource guide. Okay. The Department of Education currently has 4 of these repayment plans, the IDR plans, income-driven repayment. These repayment plans exist on a continuum. with SAVE being the most generous and income contingent repayment being the least generous. And they have differences in several areas. How your discretionary income is calculated, what percentage of your discretionary income you pay, whether there is a cap on your payments, how long you will pay, and what kinds of loans you need to qualify for each IDR plan. Most of this is explained in the chart on page 2 of the guide, and both the FSA site and Summer will help you assess all these factors and recommend the IDR plan that is best for you. However, we want to go into a little more additional detail about the newest income-driven repayment plan, the Saving on a Valuable Education or SAVE plan. Okay, so that's the new one. Let's see. Okay, so this new plan will replace what was called revised pay as you earn. And if you are currently enrolled in, it's REPAYE, the repay, revised pay as you earn, you will automatically be transitioned to the new SAVE plan. For the next several months, the Department of Education and loan servicers may use the terms repay and save interchangeably. Regardless of what they call it, the details that we're describing will be the same. The changes in the SAVE program will bring significant savings to borrowers. Some changes started on July 30th, 2023, while others will be put in place on July 1st, 2024. The following changes are currently in place. So we have what's called discretionary income will be counted using 225% of the federal poverty guidelines instead of 150%. So that's good. This more generous calculation of discretionary income means that less of your money is on the table and to determine your monthly payment, and your monthly payment will be lower. Under SAVE, any unpaid monthly interest will not be capitalized back into your principal, meaning that in this payment plan, you will not see your loan balance grow due to unpaid interest. So that's really good. This change applies to all 4 income-driven repayment plans. Married borrowers can exclude their spouse's income in determining their monthly payment if they file their taxes separately. However, they will also have to exclude the spouse as part of their family size. So you have to look at it and see which one works best. This change is a small step back for a small number of borrowers, but will benefit all borrowers by making it easier to recertify their income. Borrowers who enroll in IDR plans using the Department of Education's platform and opt in to accessing their income data from the IRS electronically through that platform will be able to have their incomes recertified automatically. So you won't have to remember to do it every year and then, have to go through a process or something. Okay. Okay, so starting July 1st, 2024, here are the SAVE changes, and the monthly payment will drop from the current 10% of your discretionary income to 5% of your discretionary income if you just have undergrad loans. So if you only have undergraduate loans, there's going to be a change in the monthly payment. It's going to drop from the current 10% of discretionary income to 5% if you have undergraduate loans. If you have loans from grad school, your monthly payment will be a weighted average of your loans using 5% for undergrad loans and 10% for grad loans. For borrowers who have borrowed up to $12,000, any outstanding balance will be canceled after 120 on-time payments, and for each additional $1,000 borrowed, another 12 payments will be required, up to a maximum payment period of 20 years for undergrad loans and 25 years for grad loans. Unfortunately, this new payment plan will not be available to borrowers who with the Parent Plus loans. Okay. Now I know I just threw a lot of information at you. So let's go through an example so you can get a sense of how these programs work. Let's see. Let's look at an example. So let's meet Anna. Anna has an adjusted gross income of $46,000 and is married and has 2 children. She graduated from college recently and has $37,000 in direct loans. Under a 10-year standard repayment loan plan, she would owe $353 every month. Let's do the math to figure out how much she'd pay under the new SAVE plan, the most favorable IDR plan that she's eligible for. Anna has, let's see, hold on, another one. Okay, so Anna has an adjusted gross income of $46,000 a year. For a family of 4, 225% of the poverty line is $67,500. Okay. Subtract this amount from her adjusted gross income. So you're going to subtract 46,000 from the 67,500 because that amount is a negative number. Her discretionary income is 0. Okay. Because she's eligible for the SAVE or repay, as they're calling it now, which currently has a payment amount of 10% of discretionary income. When you multiply her discretionary income by 10%, it gives you 0. So that's what she'd pay over a year. So you divide it by 12 and you'd see that she'll be expected to pay $0 per month, every month. I'm not expecting you to do the math to figure out your own situation. If you turn to page 3 of your resource guide, you'll see that we put together a grid so that you can quickly get a sense of what you'd be paying. There is no maximum income that will prevent you from enrolling in the income-driven repayment plan. Eligibility is based on your debt to income ratio, not on how much money you make. There are a few important items to note about income-driven repayment plans as you think about enrolling in them. First, you must recertify your income at least once every year. And if you apply at the FSA's website or through the program called Summer, you will be able to opt in to accessing your income data digitally using your most recent tax return, which will allow your income and family size to be verified each year automatically. However, if you choose not to opt in for whatever reasons, for example, you want to include an older family member in your family size, but they're not counted as a dependent by the IRS, you will need to complete the recertification each year on your own and provide additional information. So if you need to recertify manually, your servicer should send you an email or a letter saying you need to recertify your income, but note the date on your own calendar when you're enrolled in the IDR plan too, so that you won't forget. Okay, you'll get a letter, but make sure you keep up with that date, because if you don't recertify your income before the deadline, you're going to be charged what you pay in that 10-year standard repayment plan. So you don't want to mess that up. You can still recertify online or with summer. It just won't be automatic. So you can still go online and recertify. Second, anytime your income declines, you know, if your income goes down, and anytime your family size increases, you should recertify your income immediately. So you have extra financial flexibility you need, and you do not have to wait a whole year to recertify for a lower payment. So that's good. So if something happens during that year, you have a baby or you lose income, you can recertify at any time and get the lower payment. We don't, first of all, we do want to make one specific note. For those of you with Parent Plus loans, you are in a less favorable situation than people who borrowed for their own education, unfortunately. According to the rules, the Parent Plus loans are only eligible for income contingent repayment, which everyone else will probably want to avoid. Income contingent repayment is the least generous to borrowers and generally means more of your money is on the table for loan payments. However, through July 2025, Parent Plus loan borrowers with more than one federal loan, be it 2 or more Parent Plus loans or any type of federal loan, can explore the double consolidation loophole, which may make you eligible to apply for the SAVE plan. The process is long and complicated, unfortunately, and because of this, the payment count for your consolidated loan may end up being a weighted average of the loans you are consolidating. But if the consolidation goes through, you would be able to receive the benefits of the most generous plan available, which is SAVE. We've included information on the double consolidation loophole on the front page of the resource guide. Through December 31st, which is right around the corner, December 31st, 2023. Keep that date in mind because it's crucial. The Department of Education is reviewing all federal student loan accounts to determine the number of payments that have been made. And this number will be applied towards the years of payment for cancellation under the income-driven repayment plan and towards the 10 years of payments for the public service loan forgiveness. Months in repayment where the borrower was not in default, including periods in any repayment plan, in extended periods of forbearance and deferment, and in any period of deferment prior to the year of 2013, excluding in-school deferments, will be counted as a monthly payment. So they're going to go all the way back to 2013, prior to 2013, as long as it wasn't in-school deferment, meaning that you're in college and your loans are deferred because you're accumulating debt, right? So that won't be counted. But any payments that were in extended periods of forbearance and deferment will be counted as long as your loans were not in default. So this count adjustment will cover borrowers with direct loans, including Parent Plus loans and commercially held FFEL, the FFEL loans. It does not automatically cover the commercially held FFEL loans. If your loans have been paused, this is the good part. If your loans have been paused during the pandemic, they already qualify for the income-driven repayment account adjustment. If you have been required to make payments on your federal student loans during the pandemic payment pause, that means you have a commercially held FFEL loan and you should consolidate into a direct loan before December 31st, 2023. If you call and find out that you have a commercially held FFEL loan, you need to consolidate them prior to December 31st, 2023, which will make the loan eligible for the account adjustment. You want to take advantage of that account adjustment. That's something that has been approved already, and take advantage of it. Borrowers with non-commercially held FFEL loans qualify for the IDR account adjustment, but you'll still need to consolidate that loan into a direct loan to qualify for the public service loan forgiveness. And you'll want to consolidate before December 31st, 2023 to maximize the number of payments that apply, because you want to get that credit for when you were, when everybody was deferred during COVID. So, and this is, if you are not already consolidated, get those loans consolidated so that they can accurately account for those months, because that's a lot of months if you're in the loan forgiveness program that you'll be forgiven for. They'll be counted as on-time payments towards your 120 payments. Borrowers who have been in repayment the longest will see their account adjustments first. So they're going to start on the people who have the oldest loans, while newer borrowers should expect to see the adjustment in 2024. So it'll be coming. Okay. So if you've already applied for the public service loan forgiveness, your payment count will be adjusted automatically. Okay. If you've yet to apply for public service loan forgiveness, we encourage you to apply as soon as possible to receive credit for your previous payments. So please do that soon. If you haven't previously enrolled in an income-driven repayment plan, you should apply soon so that you can start saving money. You can apply online at the federal student aid site, studentaid.gov/IDR. Before you complete your application, you'll be able to use the FSA repayment calculator to see what your monthly payments will be in all the repayment plans you're eligible for, to ensure that you can afford them before enrolling. You can also use the summer platform that's available for free to American Federation of Teacher members. Summer can also help you figure out what plans you are eligible for and what you'd pay in each before you enroll, as well as guiding you through the enrollment process. Finally, you have the option of requesting a paper application as well. Remember, do not pay someone to enroll you in any of these plans. If you're contacted by a company trying to charge you, file a complaint with the Consumer Financial Protection Bureau. Do not pay. It is free to do. So what are the pros and cons of income-driven repayment plans? Let's start with the potential downside. First, depending on when you reach the loan cancellation under the income-driven plan, you may be required to pay income tax on the amount forgiven. Through 2025, the law is that income-driven repayment cancellation is not federally taxable. Okay, through 2025, it's not federally taxable. But your state may treat the canceled amount differently. So it depends on what state you live in. After 2025, your guess is as good as mine. There are many exemptions for determining if the amount canceled will be treated as a taxable income. And you should talk to a financial or tax advisor to see what your situation may be and how to plan for it. Next, you may also wind up paying more in interest under these plans than under the 10-year standard repayment plan. So that's something to look at too. Because the repayment period is extended up to 20 to 25 years instead of 10 years. So that's why It just depends. So before they were giving you 10 years, now they're giving you 20 to 25 years. If you enroll in the new SAVE plan, any unpaid interest will be forgiven. But borrowers enrolled in the other income-driven repayment plans will still accrue interest. So the SAVE plan, the interest will be forgiven. So if you're going to qualify for public service loan forgiveness, this is more of a paper problem than a real one. The interest is forgiven along with everything else, but some borrowers find it very unnerving to see their balance grow. So enrolling in the SAVE plan is your best option to avoid seeing your balance grow due to unpaid interest. Now let's talk about the pros. I'm tired of talking about the cons, right? So the pros of the income-driven repayment plans. Income-driven repayment plans are like a social safety net for student loans. You can always pay more than the minimum payment and pay off your loan earlier. But in months where something unexpected happens, you'll have more flexibility. However, paying more than required is generally not a good idea if you're pursuing the public service loan forgiveness, because you have to make a certain amount of payments for public service loan forgiveness. So if your months, they're counting your months. So if you pay up early, then you're paying more than you probably would have ended up paying, if you get what I'm saying. I know it's a lot. These plans are also better for most borrowers than a deferment or a forbearance. A deferment or forbearance suspends your payments, but will not count as a monthly payment towards loan cancellation or forgiveness. And any interest accrued while you're in a forbearance or deferment will be added to your principal once you resume repayment. If your adjusted gross income is low enough, you'll be asked to pay $0 a month in any income-driven repayment plan, and that will count as an on-time payment and moving toward the eventual discharge. So if it's if your payment is zero, they're not looking at how much you owe. They're looking at your payment was made at zero for that month. So that counts as one of the 120 payments. It is important also to note that the months in the COVID, this is very important. Pay attention to this. The months in the COVID payment pause from March 2020 through the end of September 2023 are not a traditional deferment or forbearance, even if your servicer is calling it a COVID deferment. So if your payments were paused during the months of March 2020 through September 2023, you were not accumulating interest, and each of those paused months still counts towards any eventual loan cancellation under an IDR plan and towards your public service loan forgiveness. So for each of those months, which is over 3 years, I think it comes out to be about 40 months out of your 120 months. That's a chunk of your public service loan forgiveness the government is covering that due to COVID. Okay, so the final pro that we'll mention before moving into the next section of these is that these repayment plans are necessary to qualify for public service loan forgiveness, and they work in tandem. So you're paying as little as possible and you're getting the maximum forgiveness on your loans if you're enrolled in one of these repayment plans as soon as possible. Okay? So what is public service loan forgiveness? I know I've talked about that a lot. Let's talk about public service loan forgiveness. So it's a federal program that could allow you to have the balance of your direct loans forgiven after 10 years, tax-free. So even though I said 120 payments, it sounds much longer, but it's 10 years, okay? It's tax-free. Public service loan forgiveness isn't a repayment plan, okay? Save or pay as you earn, those are payment plans, repayment plans. Public service loan forgiveness is not a repayment plan. It's a separate program that incentivizes a career in the public service. So it's for people who work in public service. Public service loan forgiveness is a different program than the teacher loan forgiveness. So there's two, that's not the same. Teacher loan forgiveness and public service loan forgiveness are not the same. If you are a K through 12 classroom teacher who works in a Title I school and who may be interested in the differences between them, we compare these programs on page 4 of the resource guide. So look that over. However, public service loan forgiveness is a much more generous program that is available to people in all job titles. So it doesn't have to have teacher next to it. And that is why we focus on it in these debt clinics. So to qualify for the program, the PSLF, you need to do the following. After October 1st, 2007. So you have to have been enrolled, or, well, you still can get in it, but after 2007 is when they're looking at the fact that they're going back that far, so making 120 qualifying on-time payments or 10 years work towards your federal loan. So when you apply for your loans to be wiped out or forgiven, which we know it's going to be after 2007, but I guess that's part of the technicalities of the terminology that's used. And you also must be working in the public service for at least 30 hours a week. And you can combine multiple part-time public service jobs to meet this requirement. So if you have more than one and you only work 15 hours a week here and 15 hours a week there, you can combine them, okay? So once you make that 120th on-time payment, then you can apply to have the Department of Education forgive your remaining federal student loan debt. You can fill the application out, okay? So, in general, to qualify for the public service loan forgiveness, you must answer yes to the following 5 questions at the same time for all of the 120 payments. The first question, do you work in the public service? So public service means that you work in the public sector or for a qualifying nonprofit. So to put it this way, it doesn't matter what you do, just who employed you. So nearly every American Federation of Teacher member is employed in the public service. That's just something to remind AFT members. Qualifying public service employers can be any level of government, federal, state, county, municipal, or tribal, including all public school districts, public and non-profit hospitals, and public and private nonprofit institutions of higher education. If you're employed and paid by any level of government or by a 501c3 nonprofit organization, you should meet this requirement. Your job title is not relevant, okay? So the next question, do you work full-time? To qualify for the public service loan forgiveness, you must work full-time. This is described being full-time, even though I just said the 2 part-time jobs, the definition of full-time in this case is at least 30 hours a week for at least 8 months of the year. You can combine hours from multiple public service employers to meet this requirement. To do that, you will need to get an employment certification form from each qualifying employer and send them in together to count overlapping periods of public service to reach full time. So, adjunct instructors, that's a perfect example. Teachers who teach and they don't work full time, but they may work at more than one college, or or they do 30 hours within 8 months, at least during 8 months. Borrowers must still be working full-time in the public service when they submit their final public service loan forgiveness application. So that's tricky for people who want to retire and they haven't reached the forgiveness point, because in order to be forgiven, when you fill out the application and if you're no longer employed, then it's like it doesn't work like that. So you have to still be working full time when you submit that final application. So once you submit that application, then you can retire if it's time. That's especially important for those who are considering early retirement, like me. So it's a lot of decisions to make, and making sure that everything is in place or working. So for our members who work as non-tenure track professors, that's just like I said with the adjunct instructors or instructors, professors or instructors in higher ed, there are some additional information. There is some additional information that we want to pass on to ensure that you receive credit for all the hours you're entitled to when you certify your employment. So for the purposes of public service loan forgiveness, the United States Department of Education has just put in place a new regulation that states that your school must multiply each course contact hour by 3.35 to determine the total hours worked in each term. So that means that teaching three credit hour courses in a term would allow you to be certified as full time. So in one term or semester, if you're teaching three credit hour classes instead of being considered 9 credit hours, you're going to get 3.35 for each, and you're going to be considered, just in this stance, as a full-timer. You can apply this multiplier back to when the PSLF program began in October 2007. So you can go all the way back if you can be verified that you taught those hours in that time frame. They're allowing you to go back to 2007, October 2007, and get credit for all those payments that you made if you're trying to be forgiven. Okay, so the next question is, does your student loan qualify? So only direct loans are eligible for public service loan forgiveness. If you started borrowing to attend college after 2010, then most, if not all, your loans are likely direct loans, which means that they qualify as is for the public service loan forgiveness. Likewise, Parent Plus loans are a form of direct loans and also qualify for PSLF. So if you started your attending college after 2010, most likely it is, but I would still check just to be sure. If you have the FFEL loan or a Perkins loan now, you will need to consolidate them. Again, consolidation, we're talking about that again, into a direct consolidation loan before further payments are made towards them. Will qualify for the PSLF. So you can consolidate these loans at studentaid.gov. You can go online and do it, or if you have access to the summer program. and it'll take you about 30 minutes to complete the form. If you consolidate your loans before December 31st, 2023, then the new consolidated loan will carry the payment count of the unconsolidated loan with the highest number of payments. Okay, so if you have more than one loan, whichever the highest a number of payments are, it's going to carry that. So it's going to backtrack, but you have to do it before December 31st. I know it's a lot of information. It really is. It was a lot of information just learning about this, really. And every time I read it, I think I'm learning something new again. So if you consolidate the FFEL or Perkins loan after December 31st, 2023, your payment count will be a weighted average of the consolidated loans. So it's very important to go online, check it out, find out what state your status, where you are. You may be good, you may be okay, you may be automatically put into save and all that good stuff, but you may not. So don't wait until the last minute, because then it could cost you some dollars. And the next question is, does your repayment plan qualify? So only the income-driven repayment plan that we discussed in the previous section and the 10-year standard repayment plan qualify you for public service loan forgiveness. So of the plans that qualify, you don't want to be in the 10-year standard repayment plan if you're planning to apply for public service loan forgiveness. Okay? Because if you make 10 years of on-time payments under the repayment plan, you'll have paid off your loans, because that's what it was geared towards anyway, 10 years to pay it off. So it doesn't make sense for you to get into the forgiveness program, because you're going to pay it off at the higher rate. You get what I'm saying? And you'll have paid it off, and you won't have anything left to forgive, really. If you end up making payments in the default 10-year standard repayment plan, those payments will count towards the 120 total payments, but you can start saving money on qualifying payments by enrolling in the income-driven repayment plan as soon as possible. Because what if you get the zero payment, or what if it's going to go according, not necessarily according to how much money you make, but your discretionary income. So it's just something to really think about. So for Parent Plus borrowers, you're currently only eligible for two of those qualifying repayment plans: the 10-year standard repayment and ICR, the least generous income-driven repayment plan. So if the ICR plan is the better option, you will need to consolidate the Parent Plus loan into a direct consolidation loan before applying. And you should consolidate, of course, before, I can't stress it enough, December 31st, to ensure that you retain all of those qualifying payments, the ones that you've made. The double consolidation loophole may provide you with the other option. So that's really something that you really have. It is a case by case. Even though a lot of people fall into one category, but it's a case-by-case situation. So when you call, they can look your stuff up and they can tell you what's best. Previous payments, and you can also reach out to AFT by that email that I sent you. Previous payments on your federal loan that you've already made in any of the repayment plans while working in public service will be counted as qualifying public service loan forgiveness payments under the IDR account adjustment when you apply. So if you still have the FFEL and Perkins loans, again, consolidate them to make sure that you get counted for the maximum number of payments. So, okay, does your repayment plan qualify? So the last question, do your payments qualify? To have your loans forgiven, you must make 120 qualifying on-time payments. That means that once you receive your bill, You pay the exact amount of the payment on that bill within 15 days of the due date, because if it's late, it's not considered on time. So it's not just making 120 payments, it's making 120 on time payments. So additionally, under the income driven repayment account adjustment, they will also count previous periods of forbearance and deferment that exceeded 12 months consecutively or 36 months cumulatively as qualifying payments, and any type of deferment excluding, not including, in-school deferments from before 2013. So you'll be able to see those periods applied to your total payment count in 2024. If you've already applied for PSLF, your account will be updated automatically. So those of us who have been enrolled in that, we should see it automatically. So one final time, I'm going to say it. I know you're tired of hearing it, but you must consolidate those FFEL and Perkins loans before December 31st to maximize the number of payments counted. Okay. So before we get to your questions, here are a few more things that we want to share about public service loan forgiveness. And these cover the questions that are most commonly asked when we have these clinics in person. These 120 payments, these 120 payments do not need to be consecutive. So if you were to make 100 qualifying payments and then you miss a month, you wouldn't start over. The next on-time payment will be counted as 101. So that means if you leave the public service, but you come back to it later, you'll pick up where you left. Okay? So what's the next payments? So, and these, this works retroactively too. So you can always certify for past payments made on a direct loan, including Parent Plus loans, in an income-driven repayment plan. And under current rules, payments made on the FFEL and Perkins loans and under any repayment plan also can be counted when you apply for PSLF if you consolidate before the 31st. So they're going to give you credit for anything that you've done. Finally, you have an opportunity to buy back periods in which you were in a non-qualifying period of deferment, or forbearance, if you still have an outstanding balance. So if you've been approved for qualifying employment for those months, and if buying back those months will complete your total of the 120 qualifying payments, then you'll be able to buy those back. So if you have already consolidated your loans, then the buyback can only be used for the periods of deferment or forbearance on the consolidated loan. So you cannot buy back months on the pre-consolidated loans. So only if you didn't consolidate. I know. So details for how to take advantage of the buyback are on the front page of the resource guide. So once you've made that 120 qualifying monthly payments and you are ready for forgiveness, you will submit the forgiveness application one final time. And when your loan is forgiven, let us know, because we want to be able to share your story so that more people know that forgiveness is possible. So like I said, you'll have the AFT email address, and you want to let us know. So how do you certify? You'll need to submit the public service loan forgiveness application. But before you begin, you should get two pieces of information. First, you'll need your employer's federal employer ID number, the EIN. You can find this on your W-2 tax form or simply call your employer and ask for it. You'll also need to know who at your workplace can complete the employer section of the application, sections 3 and 4 on page 2. So contact your employer's human resources department about where to submit the form, including the person's name and email address and phone number. Uh, get that information, and you and your employer can complete all of the application online using the PSLF help tool at eight at it has the HTTPS but at studentaid.gov/PSLF. As you complete your portion of the application, you will need to provide the correct email address for the person that is authorized to certify you. And what they can do is certify your employment digitally by signing the form digitally. And the person will, so they'll receive an email from DocuSign on behalf of Federal Student Aid. And once that form is certified and signed, it will be electronically submitted to Mohela, the only servicer who processes public service loan forgiveness accounts. So that's Mohela. You'll be able to track the progress of the application on your studentaid.gov dashboard by clicking View All Activity under the My Activity tab. And you can also use the free Summer Student Loan app to apply. If you use the Summer app, you'll need to complete the online portion of the application and get the form to your employer. Summer can send the form directly to your employer to complete digitally. Some employers don't accept applications from third-party apps like Summer, so if your employer doesn't, then you can request a PDF of the application to submit to your employer from hello@meetsummer.org. If the form is completed digitally, it will be sent back to Summer, who would then send it to Mohela for processing. So if you have the form completed by your employer manually, you can email it back to Summer to forward it on to Mohela, or you can send it directly to Mohela yourself. So the information about where to send these forms is on page 4 of the application. First-time manual applications will need to be submitted via email or fax. And once you have an account with Mohela, you can upload future documents directly to them through the portal. And okay, so we recommend filing your PSLF application as soon as possible and at least once a year moving forward. So sending the PSLF application is the only way you can receive an updated count of your qualifying payments. After you make the 120 payments, you will submit the public service loan forgiveness application one final time. And then receiving the updated payment counts and loan forgiveness is an exercise in patience, just like sitting through this presentation. In the best of circumstances, it may take up to 8 weeks to process your application and notify you of your payment count. Right now, however, the student loan servicing system is completely overwhelmed and there is a massive processing backlog. Mistakes are distressingly common, and we know that the loans are being forgiven, and we've been able to work with FSA to have mistakes resolved to the borrower's satisfaction. In the near term, don't expect things to happen quickly, but do know that having your loan forgiven will be worth the wait, and we will be here to make sure that it happens. So finally, keep track of everything, print everything, ask for written verification, keep your own count of your payments. Public service loan forgiveness is only as effective as the people who carry the program out, and you should expect that you'll have to hold them accountable. Okay? So these are some important resources. You can find and share this information that we've covered today on our companion site, the website, cancelmystudentdebt.org. This is this and other resources are listed on the front page of your resource guide as well. You can reach if you let's see. If you're an AFT member, you can enroll in summer by first you have to create a free AFT member benefits account. So we've given you instructions on how to create the account in the last document in your resource guide. So once you do that, you'll log in, go to members only benefits area, click on the link for summer. We've included summer's borrower support email addresses in the resource guide as well. And once you've enrolled in summer, then you can communicate with them, and that will be the best way to have your questions answered. And that's if you are an AFT member. If you're not already an AFT member, why not join today? You'll not only get access to this great tool, but you'll be part of a movement to provide fairness in the workplace and create solutions to end the student debt crisis and bring down the high cost of higher education for everyone. And you can reach us at debtclinic@aft.org with additional questions that may arise in the future, or if you have trouble accessing summer. Okay. So finally, we're going to continue educating people about how to use these tools to manage their student loans and reach loan forgiveness. So encourage your coworkers to join us at one of our upcoming debt clinics and register at go.aft.org/debt clinic webinar. And if you have any questions, like I said, reach out to AFT, to our contact, and I'm going to upload let me see. I want to, because I need to have an account of how many people use the resources, attended, because typically we would do this in person and we would have an attendance sheet. So what I'm going to do for the resource guide is have you reach out to me via my email address, or if you just, I guess you could just say interested, and maybe I can inbox you or something like that. But yeah, because I do need to have a count, because they're asking us for like an attendance roster of who received this information, and so that we can keep it for AFT to see how many people we're helping. So my email address is SWAAGFOUND, just like you see it here, @gmail.com. And you can always contact me that way, or either leave a comment. I know you probably, I don't know how you feel about leaving your email, but or your name, but I want to be able to account for it. So thank you so much for attending. I know this was a long presentation, but it was so worth it, especially if it can help you be forgiven. People have really been like shocked at the amount of money that they've been forgiven for student loans. I know I'm just holding my peace to see if I can be so lucky, because, oh my God, those of you who have a lot of student loans, my student loans covered 4 degrees. So I'm ashamed to even say how much I owe, but that's okay, because just the fact that they're giving us credit for 40 payments is phenomenal for during the COVID. So I'm going to end this presentation now. Please let me know how you liked it. I'm sorry if it was confusing. I know there was a lot of information, and I was trying to keep it within an hour. But like the video, please share it, and make sure you are subscribed. I also have membership badges, and I look forward to speaking with you again soon. I can, I will.